Much better. We've got value of the debt at 40 million, and that is before tax. And we've got the current stock price of this firm. Let's go firm I. Okay, you guys, what is the weighted average cost of capital formula? I wrote it out here. You just take basically, and this is the very first step you want to look for your weights, okay, and the value of your debt, the value of your preferred stock, the value of your common stock, add those together, get the total value, and then take the proportions. Now remember when it said what is, in fact I can just work on this. It says what, you know what, I'm going to flip this around. Says, you know, we've got 40 million of debt, 21 million of preferred stock, but the cost, okay, and again, the value of the common stock is $25 per share times 3,950,000 shares outstanding. That would be the value, current value of the common stock if this was the going price. Now, before tax cost of debt, 9%. So RD, D as in dog, equals 9%. RPF, or the cost of the preferred, is 11%. And then I'll go in, we use the CAPM to calculate, capital asset pricing model, to calculate the cost of common stock equity. Okay, so let me show you how we do that, and I'm hoping you guys can see this all right. Now, I'm looking through the givens here, and I see the cost of the current stock is $25 per share. Outstanding shares of common, 3,950,000. So we need to find out the total value right there. Which is also called the market capitalization. Return on the market. We've also got the risk-free rate. We've got the beta. So I know that I can figure out what they call RS. Okay. So again, first you start with the weights. So let's do that first. Okay. I can get my handy dandy. And again, this is taking from number 1 right here. Okay. Let me get my handy dandy sheet here. Let's do, I wrote some. I was going to have you guys work with what they call comps, or when you don't have dividends or cash flow, and you have to use other measures and compare them to other companies. Take an average, and let's say if it's earnings per share, and then apply that. But we're not going to do that. Okay, so in this case, let me just kind of use both these right here. I think we'll be better off. In this case, oops, I just bumped it. Okay, so let me calculate what we know to be true at this point. I have, let's say our debt. Okay, in this case, I need to figure out how much the current price is of the common stock, and times the number of shares outstanding, because I'm after the total value. So again, what would be the formula for weighted average cost of capital? Would be, if you had debt, it would be the debt over total value. Right? Okay. Times whatever the cost of the debt is. All right. And you know what? Let me flip the phone here and see if I can get a little better angle. Let's do this. There we go. And with this, I've got, are we recording? Yes. We want to take the after-tax cost, so 1 minus T of the debt. That's one component. Okay, the next component would be of the preferred shares. So what's the value of the preferred shares? It is, in this case, $21 million of preferred share for firm I. So we would do preferred stock value, okay? And hopefully you can read my writing, okay? And again, this is total value, which we're going to get in just 1 minute. Okay, I'm just writing out the formula. And we would take times the cost or the return of the preferred, okay, which is RPF. The last component would be of our common stock. So that would be, in this case, it would be market capitalization, or the, let me just put a C, common, okay, stock. All right, can you see that? I'm hoping. Value, all right, which is the same as if we take the $25 per share times 3,950,000 shares outstanding right now at this moment that the company has issued, okay, all over total value. All right, and this would be total value, excuse my writing, and this would be RS, okay, the cost or the return, which is also considered the cost, opportunity cost of using the common stock to finance a firm, okay? So, or to, that's why we use it in the weighted average cost of capital. So when we do this, the very first thing we want to tackle is total value and get total value, like I just talked about. And if I repeat myself, sorry, you know what time it is for me. So with this, let's put the debt down here. Debt is 40 million. 40 million. Okay, preferred stock is 21 million. All right, and what is the 21 million? Okay, and this would be, in terms of our common stock, would be, I want to make sure you can see that, 3,950,000. Okay, times 25 equals, that's 98,000, or excuse me, 98,750,000 in value, and this would be common, okay, stock, or the market capitalization of the company. This would be preferred. All right, this would be the debt. We add them together. That gives us our total value, which we can then take the weights. So we take the weights, we multiply everything out along with the givens, so the cost, and you get your weighted average cost of capital in percent. So if I added this together, 98750 plus you got 21 plus 40, 61 million. Okay, that's going to give you 159,750. All right. So if you want to take the proportion of that, and let me keep on working down here. If we took, and let's store this in spot 1 here. Now, if we took the debt, for instance, that would be 40 million, okay, divided by, recall 1, the 159,750,000, 159,759,000. That would give us, this would be, so let me write this out. I'm going to run out of room. 40 million, I just write million, over 159,750 million, which is the total value of the firm's financing and investments. And if we put this in, let's just put the zeros, okay? That's going to equal 25, and it's pretty important that we use at least 3 or 4 decimal spots. So this would be 25.039. I like to use it like that. And then our next one would be 21 million, okay, divided by the 159,750. All right, and our third one, or common stock, would be 98,750,000 divided by our total value of 159,750. Okay, and that would be common stock. The proportion of common stock owned by the company for our weighted average cost of capital. So if we looked at this, this is percent, okay? Our next one would be, let me put this together. We've got 21 million, okay, divided by, recall 1, equals 13.146%. And that would be the cost of, the proportion held of preferred stock, okay, in terms of the value within all the company financing. Remember, we can use debt, preferred stock, and common stock. Okay, and our very last one is, let me store this up here, and let me put the other one in there too, 0.25039. Store that in spot 8. Okay, and our last one, common stock. The value of common stock held by this company out of its total financing possible and value would be 98,750. Okay, divided by, recall 1. That gives us the value or percentage proportion of common stock held out of all types of financing for the firm, 815%. Okay, so 61.815%. All right, once we have these, and you can keep these as decimals if you want, you can do this in Excel. Now what I'm going to do, I'm going to use actually the yellow sheet that I had prepared. And let's use this to finish off our equation. Okay, so our equation, if I was you, I would actually spell it out and put 40 million over 159,750, and please perform all the work and show all the work. You know, I'm kind of a stickler for that. In this case, though, I'm going to cut it short, and I'm going to say 0.25039, okay, which is this one right here, debt over total value, okay, debt in terms of money over total value, money, okay, times the cost of debt, which in our case, we're looking at the after-tax cost, so this would be, where's RD, value of the debt, and before tax cost of debt is RD is 9%, so 0.09. Okay, and our tax rate is at 31%, so we have 1 minus 0.31. Okay, and then that would be I would put a little extra brackets around there. And then let's go to our preferred. So this would be debt. All right, this is going to give us one large whack. Okay, and I've got a definite site to recommend. I don't going to give you guys all these. I'm going to give away all my secrets here. Finally, we've got preferred, which is, in this case, we figured it out to be 21,000 over 159,750. thousand. So 159,759,000. So that gave us a 146, okay, percent. And that's the proportion held of preferred stock times the cost of preferred, which I believe was, let's see, cost of preferred is 11%, 0.11. Okay, so everything's held in decimal. All right, and finally, we have, and we still need to figure this out, where we did figure out in terms of RS, okay? We did figure out the proportion of common stock held using their market capitalization, which is just those $25 per share times 3,950,000 shares. Now, once you get this proportion, last thing you need to do is you need to actually calculate what RS is. And RS, in this case, which is the common stock, would be equal to the risk-free rate, which is the same as the capital asset pricing model, okay, plus whatever the beta is. In this case, it's 1.3, okay, so beta, times the market rate of return on the market minus the risk-free rate, okay, and that should give us, let's see, we have 0.02 plus a beta of very volatile of 1.30, excuse me, and our return on the market, if I can see here, is 10%. So we've got 0.10 and minus 0.02, and that will give us the expected return on stock, okay, or the cost of using common stock, yeah, for financing. So this is going to give us, let's see how much that turns out to be. And again, this is using the capital asset pricing model to get the return on common stock. So that would be 0.08 times 1.30, okay, is 10.40. So that would be 12.40%, okay, or 0.1240. All right. Again, that's point. Let's see if you can see that point. And there's kind of a shade there. Let me see if it gets a little better there. All right. So we've got 0.1040 plus 0.02 gives us 12.40%. All right. So let me go back to here. And now I'm going to take this figure and input it. Let's carry on this calculation. This would be the value of common stock, which again we figured out to be 98,750,000 divided by 159,750,000, which gave us about 61.815% of holding common stock out of all the financing possible of the company. So I'm going to take that percent, and let's say 0.61815, okay, over, or times, excuse me, 0.1240. All right. Now, when we multiply all these together, we should get the weighted average cost of capital, which again is taking into account the risk of each different type of financing used by the company, from debt to preferred to common. So with this said, let me go ahead and finish this one out. And this would be, I'm hoping you guys can see this. This is kind of not the best light. Let's see if we can see this here. I can see there's a shadow nose, right? Let me see. A little better? A little better. So with that said, I might have to change rooms here. That should give me, let's see here, what do we got? Let's see if I use that. So this should give us, let me multiply it out. This will give us Make sure it's still recording. Just recalculated this, or calculated it, excuse me, and I came up with 0.10666, which gives us about 10.67% for the weighted average cost of capital. And in this case, we are using it like a hurdle rate, which will allow us to evaluate the investment. Again, the question is, if the investment project generates a return of 11%, and the weighted average cost of capital is 10.67%, obviously the investment passes the test and surpasses the 10.67%. So we would accept the investment project. Okay, and that finishes up number 1 right there. Okay. And I need to change lights. Okay, now we go to number 2, which is a little different for you guys. Not too much, because it still comes down to, again, I do include all the Excels in these. And let me show you the formula that we're going to be using. It's the horizon value model. So this should look pretty familiar. So for number 2, all we're doing is doing a couple things here. And let me show you in the book too as well. Again, in the book, let me show you where weighted average cost of capital is found. Okay. And weighted average cost of capital is back in chapter 19, which should be, see here, it's actually in chapter 9 as well, now that I think about it. Chapter 9, yep, risk and cost of capital. We're going to see what we got. We've got the CAPM there. Weighted average cost of capital, page 231, ladies and gentlemen. And it goes into calculating when you've got just debt and equity. Okay. If you want to look it up, let's say on Investopedia, you'll get a better idea. But again, the after-tax WACC, which is here, they're just taking the after-tax cost of debt and its times its proportion, and the cost of equity or return on equity times the proportion of the equity held out of the total value. Again, that's page 231, 232. And then I flip into chapter 19, which is, see if I can get this here. And the problem that I'm doing, in case you want to look it up with the solutions, I'm doing a very similar problem to number 24, which is company valuation, using the weighted average cost of capital. And then what we do is we use the free cash flow or cash flow from assets formula, which they kind of lead us down through. And I'll show you the one in the book actually within the chapter. And again, I will also show you the one in the problem. But just to give you an idea of what formula, there's only 2 parts to this problem. Basically, the first part of this problem, and let me see if I can zoom in here since it is kind of small. The first part of it, and this is working the steps. Let me see if I got a bigger. So I pulled out the other version I have, and I did write down the steps here. It said, calculate the free cash flow amounts from years 1 through 5, given your financial statements and the layout. Okay, and so if we looked at this, we would normally be given something like this, which is basically the financial statement along with changes in working capital and changes in net capital spending. Okay, or basically fixed assets, long-term assets. And so this is normally how we're given this portion of it. Notice that there is a 1 minus 2 minus 3, and there is a 4 minus 5, 6 minus 7. That kind of leads you down through it. The formula for free cash flow is when you take sales less cost of goods sold less other costs, okay? You add in any non-cash expenses like depreciation. So number 8 plus 5, okay? And these are the line numbers here that correspond to it. So once you get to the very bottom, again, we've got EBIT, then you got the tax, you take the tax out, and again, the tax rate on this particular problem is 35%. But I'm just basically showing you the gist of how this problem works. We take the free cash flow, then once we get the free cash flows, which you put in right here, okay? And the formula for that, again, for free cash flow is basically the operating cash flow, which is, let me show you, is basically the operating cash flow, which is sales less cost of goods sold, other costs, okay? And you add back in depreciation. That's where this comes from, line, I'm sorry. You keep continuing. Let me stop that. So again, the formula for this free cash flow or cash flow from assets, okay, is basically the operating cash flow, okay, which is basically your profit, adding back in any non-cash expenses. So in this case, we would be taking the tax, profit after tax, okay, line 8. And if you follow it down, everything's given to you, including the latest out to the forecasted amounts based on growth rates. And then you take away any long-term spending and on capital or fixed, long-term fixed assets. That would be number 10, line 10, investment, change in gross fixed assets or net capital spending. You also take away any change in working capital. So it'd be 8 plus 5 minus 9 minus 10. Okay, and they give that to you right there. So you're going to take these right there. This is what you're after. And again, don't forget to add back in depreciation right there. Okay, so the very first one in our case would be, if we worked it, okay, the very first cash flow would be, and I'm hoping you can see this, and we have a depreciation of 5,678. So let's do this. We would take number 8, which is our profit after tax. So 68.71. Okay. Add back in your depreciation plus 5,678, and then minus number 9. I'm just following this right here, which is the formula. Okay, and this is also the formula, as you can see below. Operating cash flow minus net capital spending minus change in working capital, net working capital, will give you free cash flow or cash flow from assets. So once we do this, we end up with, I believe we have one more to go, which is taking away 65.54 should give us about, and that looks about right. We would put in for free cash flow 5, and everything's in thousands already. So we've got 5,995. Okay, and I'll verify that right now with my formulas, and I'm off by a little bit. Shame on me. Where is it? 6871. Okay, then we're going to add back in a non-cash expense, which would be plus 5,678 equals 12,549. Then you're going to take out net capital spending and change in net working capital. So take out 781 minus 6,554, and that will give you 5,214. Okay, and that, ladies and gentlemen, is correct. Okay, so I actually end up with This is the practice problem. These are my free cash flows, all right? So once I get to free cash flow, I take it immediately to the formula, okay? But before I can get to there, I need to take those cash flows and make a few changes. And I'll show you what we can do. We can actually take this and put this on a timeline. It'll make a lot more sense. Remember that everything is in terms of thousands, okay, on this sheet. And so what you want to do is basically we're using the horizon model, and the problem actually says, let me read through it. Number 2, it says, following a micro and macro forecast, the sales and revenues and costs based on a number of key sources of information such as historical income statements, balance sheets, trends within NT's industry, the consumer discretionary goods industry, including time, scale, risk of the firm's revenue. NT Incorporated, a direct competitor to Tesla, that wasn't far off, demonstrates that the volatility, cyclical, and highly competitive nature of NT's focus on renewable energy storage and innovative automobile manufacturing. Okay, and again, it is set up in an Excel model. You want to put down the givens, the weighted average, and this is actually Moodle. I don't know how Blackboard got in there. Moodle. Okay. The weighted average cost of capital is 12%. Remember, basically all you're going to do is get the free cash flow. You're going to take away, once you get I'll explain in a minute, but you take the free cash flow, you put it on a timeline and start to work with it, because you are after getting the present value of the firm, just like taking the present value using dividends, except we're using free cash flow. So weighted average cost of capital is 12%, so that's your discount rate. Long-term growth rate starts in year 5 and thereafter, and is forecasted to grow, and thereafter is forecasted to be 7.5%. Okay, so the free cash flow will grow at 7.5% beginning in year 5 and after, due to high demand for this innovative company's products. The company currently holds $9 million in debt instruments. Now remember that when I'm looking at this, I don't know if you guys can see that or not, but when I'm looking at this, you want to be sure that before you get to the present value of the company, and it's actually made into this Excel, you take out any debt, okay? And that will give you, basically, you're taking into account the value of the equity, okay? Not the debt at this point. And you get the present value, and then you get the value of the share, okay, on a per share basis right here, all right? And then you compare it to the going price and see if it's under or overvalued, all right? So it's very similar to the dividend problems that we've worked. So again, I went back here. And so what I would do is, after doing the free cash flow, okay, go directly to, and again, I kind of wrote out the steps, go directly to putting down these items, free cash. Okay, you guys, we're back at it here. I'm using a little different lighting than last time, so I'm hoping you'll be able to see these. Okay, especially with the zoom. As I do try and make it zoomable. Okay. So let's do this. Remember, number 1, you get the free cash flow. Number 2, you break it down using a horizon value model. You can find that in chapter 4. And in chapter 4, we started to use that. I'll show you real quick. Except we've never used one like this. Excuse me. In chapter 4, we used right here, and I purposely did not go through it at that point because I knew we'd be going through it at the end of the semester. This is on page 99. Very similar feature, okay? and a value range for the concentrators business. And in this case, they actually do go through it in estimated horizon value. And again, you can see it right here, valuation format. That's taking off from using the dividends, okay? And it goes from page 96, 97, 98, all right? That's a different way of looking at it. Okay, so you guys ready? All right, let's finish this baby up. So the very, very last part of this is once you have identified the free cash flows, you're not going to use year zero. You will use the free cash flow from year 1, year 2, year 3, which are right here in red, okay, up to year 4. Since it's already forecasted that year 5 and after, the free cash flow will grow. Now we're going to take it to the timeline. Okay, so don't worry about this stuff right here unless you want to use the Excel template. Then everything's kind of built in there for you. First of all, I want to get the present value of the cash flows using the weighted average cost of capital, which is the opportunity cost of capital, which is 12%. Okay, so I would take the present value of each one of these individual free cash flows, excuse me, and get the present value and for years 1 through 4. Okay, and that's what you get right here. That's 18,194.64. The very last thing we do is we also bring in this last cash flow out in year 5 back in and discount it at 0.4 or year 4. When we discount it, we get the price or the horizon value, okay, which is this right there. And actually I kind of roll all those together. This is actually how you get both steps, okay. So let me show you what we do. And again, looking at this, year 1, we've got, remember this is in thousands, so this is really $4,580,000. But in this case, we've got 4580, 4934, 9872. I'm struggling to read this. 4950, and then our 5th year cash flow, which is already forecasted at 7536. That's based on the growth rate. And that growth rate usually comes from estimates given by an analyst, okay, which you can easily look up. So here's what I have, and let me make sure you guys have the right one. So we take, in order to get the value of the firm, since we've just finished following the line numbers here, how it's set up, and taking the operating cash flow minus net capital spending minus change in net working capital, okay, that gives you your free cash flows. Use those free cash flows beginning in year 1, year 2, year 3, year 4, and take year 5, remember, and just bring it back in by 1 point. This does, they call it horizon value because it grows at a constant rate, okay, for a long time out. So what you're going to do is actually take this same 7563 and put it into an equation. And let me rewrite this one so it looks a little neater and change pens. You're going to put it into an equation that looks somewhat like this, okay? So you're going to put it into, let's see if I can tap this out. An equation that looks like present value of the firm, okay, at time 0. All right. And let me step back a second. To follow what I was just saying, you want to get the horizon value, okay? So this, you're going to take the 5th year cash flow. You're going to plug it into a formula that looks very similar to, so PH, okay, price at the horizon, right? So we're going to get the price at the horizon, which is right here at time 4. And that's aside from these first year, second year, third year, and fourth year cash flows. So once we bring this baby in, which represents all future growth at a constant rate, and we do that just like this. So PH is equal to the free cash flow, okay, H plus 1, all right, and the horizon being at year 4, because after that it changes. And then what we do is we take the weighted average cost of capital, which is 12%, minus the growth rate, or expected growth rate, constant growth rate. It's the only way we're allowed to use this. And this is very similar to what will be called the Gordon growth model. Sometimes they call this the terminal value. So in this case, we've got 75.36, excuse me for my terrible writing here, over 0.12, okay? Now there's something we got to do here. What's our growth rate? Our growth rate in this case, looking back, our growth rate is going to be, long-term growth rate, 7.5%, right? So if I do the 7.5%, which I just dropped my pen, okay, minus 0.075, all right? And if we do this, this should keep us on the straight and narrow. And let's see what we get and see if it's in comparable terms. So remember, these are in thousands, so this is really 7 million, but it's okay to keep it in thousands as long as it's consistently in thousands. So let's see what we get. So PH, because after this, then what we're going to do is we're going to add it on, okay, to first year cash flow discounted, second year discounted at the WACC, okay, the 12%, third year discounted, fourth year discounted, and then we take that fifth year and bring it in and discount it at the fourth year again, which is this one right here, okay? So first of all, let's see what we get. So we get, and that would be 7,536,000 minus, excuse me, divided by, let's do this, put 1,2 minus, I don't feel like thinking tonight, so I'm going to do this. Okay. Let's do this. So this is, are we recording? Yes, we are. Okay. So this would be, let's see, 0.12 minus 0.075 equals 0.045. Okay. You've got the 75,536. All right. And in this case, this is going to give us, or 75,36 divided by 0.045 should give us, that's right. It's right on the money. Because we do have 167,462.22. Okay. And I'm hoping you can see that. Let me see if I can zoom in a little more better. Okay. And so we have that value. And once we have that value, we can combine it with years 1 through 4. All right. And I'm doing it the manual way, of course. So let's get this to present. The price at the horizon, okay, will need to be discounted. So this will be equal to 167,466.67, okay, and that represents pH, okay. Now that we have that, we can actually divide it by, and the weighted average cost of capital is 12%, and remember that we're bringing it in from year 5. Okay, year 5. This was free cash flow at year 5. All right, year 5. And we'll bring it into time 4. All right. So now we will have, it'll kind of look like this. All right. So we have 1, 2, 3, 4. You have that 5th year out there. You brought it back in, all right? So you're going to have, in terms of cash flows, you're going to have the 4950. That's regular free cash flow for year 4, right? 3, 2, 1, 0. We don't have any cash flow here. We're just taking the value, all right? And in this case, we've got, let's see, what is it? 4950, 98, 72. All right, and that's 49, 34. Why in the world did I put a comma there? Okay, and the first year cash flow is 4580. Okay, and remember that what you're going to do now is you're going to divide this by 1 plus 0.12, okay, to the year 4, because we brought it into year 4. So we're going to have an additional amount there, which is PH, that we're going to discount, okay? So our formula actually looks like, and you discount it, 1 plus WACC to the 4, okay? And once we do that, it looks very much like this equation that I just did, okay? And here's my discounting at year 4. And so to get the present value of the firm, we just take 1 plus 0.12 to the 1, 1.12 to 2, 1.12 to the 3, okay? And we take these last two, okay, and I'll put them separately. Well, I guess we could list it this way. So let's do 1.12 to the 4th, okay? We add these together, okay? And let's not worry about this right now. We can do this in a separate down here, okay? And if I do these calculations, this should give me present value of, and again, it will give me 106,425, okay? I'm sorry, that's of the horizon value. The present value of the free cash flow for years 1 through 4 will be about 18,104.54. I kind of scratched it out. So if, of these right there, okay, and remember that was set up in Excel. This is going to give you about 18,000. Let's see, 18,104.64. 104.64. Okay, that's years 1 through 4. Then we have the horizon value, okay, or PH, and that is 167,466.67. Okay. Now, what you want to do is you want to discount this one also as well. So that will be 1.12 to the 4th as well. So you're also going to have, so you're going to have this, and then you'll have that one in the 4th year. So if we do that, that will give us divided by, so let's store this, and this would be 1.12 to the 4th equals store 2, okay, 1.5 should be, let me put it over here, 167,466.67. And my gosh, I'm putting my work out of your range, huh? Sorry about that. And this would be, that's what I usually stand up when I'm doing this. And this would be the discount factor would be 1.57352. Okay. And let's take this, store it, and spot 2 and recall 1 divided by recall 2 should give us exactly what we I thought we were going to get. We got 106,425 and 27 cents. So now we've got present value of the horizon, okay, or PH. And so we discounted this. This was back out at time 4, representing all those future constant growth free cash flow. And there's a value to that, and that's what this is. Now we discount it into the time 0, and that gives us, what do we get? 0.0942. I was off a little bit according to this. I'll put down what they got. 106,428.10. You could round it. Okay. Actually, I put down 428. I'm off by a couple bucks. They got 106,425.27. So with that, let me just put down what I got. 0.942. Okay. Now all you have to do is basically combine these right there. Okay. These two figures. And remember that these are in the thousands. Okay. And so what you do is you combine them. And if we combine them, let's store this in spot 3. Okay. And let's put the 18,104. 18,104 point, is it 0.64? Right there. Okay. Of present value of the free cash flows from year 1 through 4. And that should give us 0.64. Okay. Plus 106,428 point around 0.10. Okay. That gives me about 124. So I'm adding present value of the horizon value, and which is the 106, and present value of years 1 through 4 free cash flow. Okay, and I get about 124, and this is more or less 32.74. And then what we do is we take away, in this case, I'm going to change the debt, outstanding debt, okay? And that's wrong. It's not in the thousands. That's 9 million. So our debt is 9 million. So I would take off the zeros on that. So it would be 90,000, okay? Because it really represents 000, okay? In the Excel, you just times it times 0.01 to knock off the 3 zeros. So in this case, we would end up with, what am I doing? I didn't put those extra, my bad. We've got 9,000. Sorry, guys. So you got 124,532.74, okay? Total present value, but you got to take away the debt. And if you took that 9 million in debt, but you kept it in thousands, it would be 9,000. So if we take the 9,000 away, which is 9,000, okay, that would give us minus 900, about 115,532, which is pretty close to what I got originally when I reworked this problem. And I got, let me see if I can zoom in here, show you guys. Okay, I got the, even though I've written all over it, 115,619.92. And I actually got 115,532. Okay. And if you actually look at the formulas inside the Excel, which I set out, you'll see that what I did. And of course, I took it out to quite a few more spots. So with this gives us our correct present value of the company, okay, in terms of dollars. Does not in terms of shares. So to get that intrinsic value of the per share price, we're going to divide it by the number of outstanding shares. And that just happens to be 21,000. So we've got 21,000 shares out there, okay, held by large block holders to individual investors. And so let's do this. Let's, what am I doing here? Zoom back in. So we would get, if we divided that by, in this case, this would be also on the 1,000, okay? So let's do this, divided by 2100 equals $55.015. Now I got a 55.06. Notice what I did. Since everything is in terms of thousands, especially this is really 115,532 million, okay, or 740. So if they tell you, oh, okay, well, you got 22,100,000 shares outstanding, you have to cut off some zeros here, just like we did with the debt, to give it on equivalent form. So in this case, I got $55.015, okay, or 0.02 per share, and that would be the intrinsic value. And then it asks if the market price is presently $61 per share, is the company overvalued or undervalued? It would be overvalued, okay, because in the market, it's way overvalued. Supposedly it's supposed to be down here, so you might expect it to drop soon. All right, so with that is really the gist of free cash flow analysis and being able to use it to value a company. Hope it helps. On the next couple, I'm just going to go through this real fast because we've done these before. The next one happens to be, and I changed the problem around a little bit. I used, and let's make sure what I used, 80 and 20%. Okay. So in this case, Drake has invested 80% of his money into share A, remainder into share B, excuse me. He has an expected return of 15% for A, 20% for B, standard deviation 20% of A, and standard deviation or volatility of B is 22%. The correlation between A and B, these shares, is 0.5, okay? Basically what I asked you to do is to calculate the expected return and then the standard deviation, all right? And of course we break it down into, let's see if I can zoom in here a little bit, into our expected, okay? And I end up getting, when I did this, and that's part C. When did I get part C here? Here we go. Here's the right one. So we've got, let's see, what is this? A and B. Okay. So what I used, I cheated. You can set a formula into your calculator or into Excel, or you can use one of the web calculators. The site explained.com. It has a expected return and standard deviation of portfolio calculator. Okay, but what I'd like you to do at least one time is to work it completely out, okay, using the formula. So let me see if I can get this in here so you guys can get the full 9 yards here. So as you can see here, we've got our expected return, okay? We've got the weight of A plus the weight of B equals 100%, right? So once you do that, 80% plus 20% equals 100%. And I worked out the expected return to be 16% on this practice problem. Okay, and not following the original one. So then I went in and I did the variance of the portfolio. Okay, and so we look at the co-weighted variance. I did 0.80 squared times 0.20 squared, etc., using the 80 and the 20 as the weights. And remember that it is the standard deviation, the variance of the portfolio just equals the weighted covariance of A, weighted covariance of B, plus 2 times the weight of A times the weight of B times the correlation coefficient of 0.5 times standard deviation of A times standard deviation of B. Then you take the square root of all that once you calculate that, and that will give you a percentage, okay? So when I do 80-20 on these numbers right there, I will end up with a expected return of 16%. And for variance, okay, I used decimals, and I ended up with 3.458%. And actually, that's variance. You can't do that. I just ended up with 345.80 or 0.03458. And you take the square root of that, get standard deviation. This is, of course, the correlation at 0.5. And that gave me a standard deviation of 18.59%. Okay, so that represents the risk of the portfolio. In B, it asks you to use other correlation coefficients such as 0, minus 0.5, minus 1. Okay, of course, if you use 0, everything breaks down into a weighted average. These are the numbers I got: 16.59%, 14.32%, and then finally the one with if you had A and B were negative, a perfect -1 correlation, you would have the lowest risk possible, which is 11.60% for the standard deviation. Okay, part C says, well, what if you held, instead of 80%, 100% of A? Would you be better off, or would 80-20 be better? And so all you have to do for that is actually, when you do that, is, and I'm looking for it here, that was my other part I had right here, is first you calculate the return. Okay, so 100% of share A, which earns 15%, okay, and that you'll end up, and this zeroes out, so you end up with 15%. The variance, same thing. You end up with a weight of share A squared, so that's a weight of 100% or 1.0 squared, times 0.20, which is the variance, or excuse me, the standard deviation of share A squared, and you end up with 0.0400, square it, that gives you 20%. So with the new combination where you just held share A, you'd have 15% return, 20% on the risk or standard deviation, versus if you had 80-20 of A and B, you would have a 16% return, 1% more, and a much higher standard deviation. I'm sorry, much lower, not much, but a little lower standard deviation of 18.60%. Okay, so clearly holding A and B is an advantage, okay, in terms of increased return and lowering risk. Okay, for parts, question number, we've been through these are just like the homework. For question number 4, what I would like you to do, and I actually embedded this into the Word, just one sec. Okay, guys, so the very last part asks you basically to, and I'll flip it back over here. And what you're doing is, and this is problem number 4, you're using the capital asset pricing model, which is found in Chapter 8. I had to think about that. And it says the Treasury bill rate is 2%. The expected return on the market portfolio is 12%, which could be like the S&P 500. It says using the capital asset pricing model, basically, if you can go through and draw a graph similar to figure 8.6, which is also found in the slides 824 and 826 in Chapter 8 in your textbook, which basically allows you to, once you plot these points, allows you to get the sensitivity of the stock to the market, and allows you to plot the expected returns versus the beta. Okay, and beta again is just price sensitivity, represents systemic risk or systematic risk, excuse me, or the market risk. So it's really how a stock or portfolio varies with the market. Okay, so it does represent market risk. A beta of 1 is normally representative of the market. Okay, so anything, if you had a stock that had a higher beta, like 1.5, it would be about 50% more volatile than the market, moving in either direction of 50% more. In this case, we've got basically like a equilibrium line of equilibrium. So you can actually price stocks, because you're not going to want to, if you got something out here that's way underpriced, actually, I'm sorry, overpriced, because if you've got a expected return up here, it's going to come back down here, and the price at the same time will go up, and it will meet an equilibrium. Basically, when you do that, what it's saying is, well, that's earning too much return for the amount of risk that it's taking on. So that's why it moves back down. And that's just a scenario, hypothetical. You guys, so basically what I ask is to draw a figure, plot the points, then it asks what is the risk premium on the market, which is just RM minus RF, using the CAPM model. So as we do this, okay, we've got the expected rate of return, which this is what the CAPM also allows you to do, okay? The slope of the CAPM, which is just this, right? And this is the market risk premium. It's the 0.12 minus 0.02, okay? And you got the beta, you've got your risk-free rate. And so in this case, what it asks you to do is to plot the points. So I plugged the different betas, everything from 0, 0.5, 1, 1.5, 2, 2.5, and get the different expected returns, okay? Then use that, compare it to the return that the stock is really earning and on the market, including its price, and then you're able to either say it's undervalued or overvalued. So what I did was I actually ended up with 0, which is basically the beta of the risk-free rate or the Treasury bill, which earns 2%. So, and I put that in there, and I had 2%. And then we went all the way up to the market beta, the beta of the market, and that gives us about a 12% return. Then we could take a beta twice as risky, and we end up with an expected return of 22%, and so on and so forth, 27%. That's kind of where the more you pay or the more risk you take on, then oftentimes you will earn a higher return. This is where this comes from, that concept. And this is the model that brings it out, okay? So again, when I do that, and then we have some other questions that need to be answered, such as what is the required return on an investment with a beta of 2? So you just plug in 2 into the CAPM formula. And the next question after that would be, and these come from the homework problems. If an investment had an expected return of 7.2%, okay, how would that compare to what it would be? This project be considered to have an acceptable NPV? Expected or required return of 7.2%. So I wouldn't say required return, would be expected return. And in this case, what you're doing is you're plugging in that beta of 0.7 and you get a 9% required return, which is, so you're using the CAPM to calculate somewhat of a hurdle rate, a required return, opportunity cost of capital. And really right now, expected return, I mean, this for all we know could be IRR, 7.2. So does 7.2 surpass that 9% required return? No, it doesn't. So that would mean it's earning a negative NPV. That's kind of how they work with NPV in stocks. Same question comes up again in E. If the internal rate of return was calculated to be 10%, would you accept the project given that the expected return calculated in part D, okay, the expected return was what? We got 9%, okay? And the 9%, and yet we've got an IRR on a project that's earning 10%. So in this case, we are using this one right there to calculate our required rate of return or discount rate. And the IRR surpasses that at 10%. So we would accept it, okay? F, part F, if the market expects a return of 13.5 from stock X, what is its beta? All you're doing is taking the CAPM formula and rearranging. So in this case, we're going to end up with a very similar situation to something such as this, okay? And you can see where I break it down right here. All right, and this is the market risk premium, or the expected return on the market less the risk-free rate. All right, and so we end up with, when you solve for beta, you end up with a beta of, now it's earning an expected return, expected of 13.5%. Its beta is 1.15, a little more riskier than the market, 15% more risky as a matter of fact. And with that, that concludes this part, and then we would go into questions 6 and 7. I'm not going to have you do that. Now, we do have one more in here, Buzz Lightyear, except this is Buzz Lightyear Incorporated. We are given the values of the expected return using CAPM as a percentage, which is 13.50. And in this case, what we are is calculating the risk-free rate. Okay, and I go through how to calculate the risk-free rate if we're given the expected return. And our risk-free rate ends up being 7.5, which is pretty high for a risk-free rate of return or a treasury bill. And with that said, you go through the motions of calculating and coming up with the risk-free rate. Now, with that said, what I am is, instead of giving you this long 3-part essay, I'm going to give you a little more pertinent questions 6 and 7. Okay? And it's coming at you. Thank you. Have a good night.